Good morning and welcome to the Market Mondays webinar. My name is Kyle Rodda, Senior Market Analyst at Capital.com. I can just see that people are still actually filtering in as far as attendees one by one. So I'll let that happen and perhaps just deliver a small monologue as we go. As you can see here, very casual today in my attire, but I'm here in London from Australia briefly, and I am not used to weather that has a 3 or 4 in front of it. Or I should say 3 or 4 degrees. I'm used to weather with 3 or 4 in front of it, but normally it's 30 something or 40 something. So nevertheless, that's why my appearance is a little bit dressed down today. But Danny isn't here either, unfortunately. She's a little bit sick, so we're going to be riding solo just for today. But maybe that will mean things are a little bit shorter and sweeter, but perhaps some more question time at the end if that happens to be relevant. But just before I go into the substance of things, and again, I can see people have filtered in now already. Market Mondays webinar, welcome along. We do this every week. Tell your friends. But importantly, just the risk warnings for our audience, for the Australian cohort in particular, if you're there, and good evening if you are. This is just to say that the information that you will receive here is of general nature only and does not take into consideration your personal circumstances. So please seek out your own financial advice before trading CFDs if you think it's relevant. Also, just in terms of the UK, when it comes to spread betting as well as CFDs, a risky leverage product, please consider your personal risk appetite and personal risk profile before trading these instruments. They are, of course, complex. And just to throw in there as well, once more, this is general information, so cannot be construed as personal advice. But the key themes and events of the week, and we'll keep it at a very high level before I begin this monologue, in earnest, and that's to say that we are still seeing volatility persist in the markets, and a lot of that is to do with the Fed interest rate outlook. We'll break down just a little bit why that's happening at the moment, and certainly the current pricing as it applies to the outlook for US interest rates. But on top of that too, we do have NVIDIA's earnings this week will be a big test for the AI industry, for the company itself, but also the broader macro landscape, because it has so much informational value when it comes to just the entire world. Of course, the United States' biggest company at the moment by market cap. And we'll also go through the deluge of data that is coming down the pipe because of the end of the US government shutdown. And, we will go through just very briefly, in fact, now, just the price action from last week as it pertains to the relief rally that we saw briefly in the market because of the end of the shutdown. But that was relatively short-lived, and we did see a new low made on Wall Street. Which we'll go through a little bit more in a moment's time. But let's kick things off with a look at Fed policy, because I think there are 2 things really driving the markets right now and the volatility that we're seeing. First is doubts about the depth of interest rate cuts going forward by the US Federal Reserve. And second is what I've called the AI-ROI trade, which is effectively artificial intelligence and its return on investment. And to what extent will there be an adequate return on investment from some of these major projects that governments and private sector actors alike are pumping money into? But the thing with the rate outlook to begin with is that we have seen a pretty meaningful watering down of rate cut expectations for the December decision. And of course, a flatter curve when it comes to the rate outlook than what we were witnessing, call it 6 weeks ago or so. And if you actually look at this wonderful tool, which if you haven't seen it before, we've spoken about it in the past, I would encourage you to look at this. I don't think that constitutes personal advice to say that this is a great resource that everyone should be looking at for your macroeconomic news. The CME Group's FedWatch tool gives you a great insight, obviously, on what the markets are actually pricing in when it comes to future monetary policy in the United States. And over the last 3 weeks, 2.5, certainly since the last Fed decision, where the now famous line from Jay Powell in his press conference is that a December rate cut is not a foregone conclusion, while the markets have subsequently moved to reflect that. And this comes more or less as a bunch of Fed officials last week delivered a fairly hawkish rhetoric, I should say, on balance. There were, of course, the normal doves on the board who have emphasized the downside risks to the labor market. But for the most part, there has been a very concerted effort to talk about the upside risks to inflation and why the Fed may need to be a little bit careful about cutting rates in December. And as you can see here, the markets have now adjusted to reflect that there is a 56%, call it, implied probability of a hold for the Fed at the December decision versus a 43% implied probability of a cut. And this makes things look quite finely balanced, and that's exactly what the Fed's trying to do. It's not trying to guide the market towards a hold decision, but it's trying to maximize optionality so that when it gets to that decision, or at least it's able to digest some of the data that it has been absent over the last several weeks or month and a half because of the shutdown, that it can go either way with policy. But this, and I'll show you just another thing this tool can do. Again, I'm not getting paid by these people. I just really like the tool. You can compare where markets were as far as rate expectations a month ago compared to now. And you can see that 1 month ago, call it 17th of October, the markets were pricing in a 93% chance that there would be a December rate cut. We're down to 43%, as we said before. And of course, as you can see here, the chances of a hold have increased a little bit as well. And let's just take another look at this tool. Again, really just to show you how it can be used and why it's useful. This is the historical line of applied probabilities for a rate cut in December. And as you can see here, peaked around the 20th of October with a 98% chance price in of a cut. And of course, this was when the markets were really fretting about the health of the US labor market and that the Fed would have to cut aggressively to try and support the labor market. Since then, shifted materially. The market's assessment of the balance of risks have moved a little bit closer towards that inflation side of the Fed's mandate. And we've got now this dive in rate cut expectations, which has to be said. We'll just have a quick look at it. What was the peak here in pricing? Call it the 20th, 21st of October. Where was the peak record high for the, say, NASDAQ? We got a record high on the 30th, but you can see that momentum really started to slow down around just after that point. So we did get a little bit of an extra rally, mostly probably because of earnings and what have you. But as the markets have priced out rate cuts in the United States, you have seen that has weighed on equities, quite materially. It has to be said. We'll come back to equities in just a moment's time. So that's really the lay of the land with the Fed at the moment, and that's having a bit of an impact on obviously gold prices at the margins too. Although we did see gold pick up again a little bit last week, and then also things like Bitcoin, other risk assets, all being weighed upon. The dollar was a little bit weaker last week, it has to be said, but I think that we'll look at the technicals in a moment. But the trend is actually quite constructive for the US dollar. So that's one side of the equation. The other side of the equation at the moment is the AI-ROI trade, again, as I've been calling it, the artificial intelligence return on investment trade. And that's just really doubts about to what extent there is the kind of growth in the Magnificent Seven stocks and return on investment on some of these massive, massive projects that are being earmarked or have already been rolled out by governments and private sector alike to justify what is really, really rich valuations at the moment. And another great resource, again, if you're on this webinar week to week, you will know this resource as well. But it's that Fact Sector Earnings Insight document, which they publish every week on a Friday during earnings season, gives you a wonderful look at what's happening in company earnings at the moment. And let's just start with one thing, which is to say that we're basically the lion's share of the way through the earnings season. Enough companies have reported to really know how things are going to shake out here. 82% of companies have beaten expectations, and earnings growth is on track for about 13.1% growth for the quarter, which is really, really strong. Also coming with some earnings revisions as well to the upside. I think that was just saying there. But let's just go through the more important metric, because earnings growth is one thing, and this is, vital. But there's also the important issue of valuation. So to what extent is future strong earnings growth continuing to being priced in to the markets, and actually this is a good chart too. This is just looking at the earnings growth across sectors for the S&P 500. Based on today, the blended earnings estimate, which takes what has already been in the earnings season with what's left to go, which is only about 8% of companies, one of which happens to be one of the biggest companies in the world in NVIDIA. But earnings growth is around 13% for the quarter. The estimate going into the earnings period was about 8%. But I wanted to show you just the chart of the blended forward earnings price to earnings ratio. And this is why market participants are a little bit fearful that we could be in, for a lack of a better term, some kind of an AI bubble. And that's because we are seeing the forward 12-month price to earnings ratio at levels that were similar or are similar to what we saw during the everything bubble in the pandemic, as well as the dot-com bubble, very, very similar in terms of forward price to earnings. And it's raising this question, is what's being priced into the markets about the future when it comes to AI, specifically its growth, and again, the return on investment, too elevated, or is it appropriately priced? And there are fears with some of the commentary that has come out of some hyperscalers during the earnings season, as well as some sort of reports around the actual profitability of OpenAI, and just generally doubts about to what extent AI is being rolled out across the economy and delivering actually productive and productive returns and stronger growth for companies in the economy alike, whether that's actually materializing or not, whether that will materialize at all. And not to get too kind of bogged down in the very high level speculative side of things, but my personal view is it really does come down to this question of, what is artificial intelligence going to be in the future? And again, how will that be a driver of growth and productivity down the line? And I am of the opinion that what the markets are more or less discounting is that we'll make a fairly steady beeline to artificial general intelligence, which will have the impact of displacing large amounts of labor, which is obviously concerning from a political and economic point of view, and adds all sorts of second and third order effects down the line. But in doing so, creating huge returns on capital, potentially into perpetuity, which means getting exposure to some of these companies and the growth prospects that they may deliver is, almost absolutely necessary. That's the bull case. I would argue that could be currently being pretty close to being discounted into asset prices at the moment. This is why valuations are so high. The slightly more moderate case is that AI is kind of cool. We use it as a search engine. That's what I use it as. Use it to edit emails and other documents. That's what I use it for as well. Do all these other cool administrative tasks and make life a little bit easier, but it doesn't deliver that kind of world-changing, labor-displacing kind of change that would really be what's justifying this kind of behavior in some of these companies and these stocks. So that's the kind of dilemma that the markets are trying to work with now. Is AI a cool thing that might help us day to day, help enhance workers in the way that they do things a little bit, but doesn't really deliver that kind of extraordinary, world-changing, revolutionary productivity growth and economic growth, or is it really Armageddon when it comes to workers? It's going to displace them, and that value is going to be accrued by these massive companies that are at the forefront of artificial intelligence. An open question. What should be said with certainty is that the markets were pricing in a very good outcome. There are now doubts about that outcome, and as a result, asset prices have to reflect that risk. And it's why we've seen tech stocks pull back off recent highs, which again, we'll go through the charts in just a moment's time. Before we do that though, just a little bit of a wrap on what we're seeing in terms of the data flow in the week ahead, because that's where we roll into both the deluge of data coming from the United States after the government shutdown, as well as what could be both the biggest corporate event, but also maybe the biggest macro event as well in NVIDIA's results. And first of all, just with the data flow, I'll get Forex Factory up, another great resource to try and go through what's on the cards, but we are going to get to start with some important labor data out of the United States, which is of course the non-farm payrolls figures. And they are heavily delayed, likely a little bit obsolete, but they will be provided in full, which according to the White House, we won't get the full picture of things in the October update because the household survey, which is what goes towards pulling the unemployment rate together, was not taken because of the shutdown. So that's some information that the Fed will be flying without going into the next decision. But when it comes to September, we'll get that full batch of data, which is albeit a little bit old, but still expected to show a reasonable tick up in employment and a reasonably stable unemployment rate, although you can't see that reflected here just yet. That has not been updated, it would seem. The critical thing for data now, though, is anything that is a signal about inflationary pressures going forward, because we know that the labor market is looking a little bit weak. The arguments or the reasons for that is open to debate as well, and will actually inform very much what the Fed does with policy going forward. Is it due to a genuine slowdown in US economic growth, or is it due to something else like immigration policy and maybe even artificial intelligence slowing the pace of hiring by businesses because people are being replaced? The policy response or the way policy approaches those different questions is quite different. If it's an immigration thing, it's a supply shock. If it's a AI thing, it's a positive productivity shock, one that maybe the Fed can justify cutting rates into. But if it's an immigration shock, maybe not so much a justification for cutting rates into, because it means that the supply side is a little bit constrained. And then, of course, if it's just because of weak economic growth and weak economic activity, then the Fed will feel quite inclined to cut interest rates, as long as we're not in a stagflationary situation, which goes to the question of data as it pertains to price stability. And anything that we get in relation to price stability this week will be absolutely crucial, because it's what's going to determine for the Fed whether it needs to be much more worried about inflation going forward and therefore pull back on the potential rate cuts, or whether it looks under control, albeit away from target. There is a very legitimate position the market has taken, is that the Fed hasn't got the guts to leave policy any more restrictive and get inflation back to target, because it's too scared to disrupt the labor market and perhaps US politics broadly, because of how important, obviously, labor market stability is. That's the kind of crucial questions that we're sort of battling here, or the Fed's going to be battling. When it comes to NVIDIA's results, what we can do is we'll just get NVIDIA earnings. NASDAQ up. I always find that this resource isn't as effective as if you go to like Reuters or Bloomberg, but not everyone has access to that. But this gives you a little bit of a picture in terms of what's going to be expected out of these results for the fiscal fourth quarter for the company, and a fairly robust $1.17 per share result being predicted by the analyst community. Let's see if we've got revenues down there too. We don't have revenues down there, it doesn't seem. But that's kind of the bottom line that the company, that investors are looking at the moment. The question is obviously the growth outlook going forward. To what extent are hyperscalers still investing large amounts in the artificial intelligence infrastructure? To what extent is that maintaining demand? To what extent, as a corollary of that, are the new Blackwell chips and the other chips that the companies that NVIDIA's rolled out, which are more powerful and designed for these hyperscalers as they look to invest? How are they being? What kind of demand are they being met with? Is there restrictions on some of those chips coming through from China, and is that inhibiting the business's ability to sell into China, which is a key growth market? How does this kind of paint a picture of the growth prospects of NVIDIA going forward, and therefore also the health of the artificial intelligence complex across the globe? And maybe what we'll have a look at very briefly is just that picture of NVIDIA, because I think one thing that, if you're an NVIDIA shareholder, is quite important to note going into these results is that we have seen a fairly meaningful pullback in the stock just because of this, AI ROI fear, and also concerns about the rate cut outlook for the United States, that we're now back pushing towards these kind of critical levels around the sort of high 170s to the low 180 level for the company. And this potentially lowers the bar just a little bit for the company to try and exceed when it comes to these results, especially given that a lot of what has led to this sell-off is macro driven. Perhaps there is now the argument might go a buy the dip opportunity on NVIDIA. Now, I'm not here to prescribe whether one should do that or not, but it's to say that at least with this sell-off over the last few weeks, the business is not going to have to fight quite so hard to exceed expectations as it normally would if, for example, the results are coming in when the stock was at record highs. And I think you can kind of see the fairly clear key levels here for the company. We've basically got a confluence of support around a little bit below $180 per share, which coincidentally was where previous technical support, previous resistance and now support happens to be for the price. But ultimately, the big level to watch and to see whether to assess whether the structural uptrend, which we can see for NVIDIA, remains in place. Like this is a market that is clearly defined by higher highs and lower lows, albeit with some slowing momentum there, as you can see on the daily RSI. That if we do break above that 210 level, whether that be because of these results or some other catalyst, that's going to be the strong indicator that the bull run in NVIDIA continues, and arguably Wall Street's bull run remains in a strong position too, because of what it says, not just about the broader S&P 500 and NASDAQ, because NVIDIA is such a significant constituent, but because what it says about the activity of hyperscalers, the AI trade more broadly speaking, and the growth that might be contained within that. Let's contrast that now with just a bit of a view on what's going on with US equities. And you can see here, I've been trading on a shorter term time scale, so let's get rid of that. But there has been a fairly meaningful change in momentum for the reasons that I outlined before in the NASDAQ. And there does seem to be a degree of risk being kind of skewed to the downside while all of this uncertainty plays out. And I think a general rule of thumb for the markets is that if there is uncertainty in the market, volatility is likely to persist until that uncertainty is relieved. That uncertainty in this case pertains mostly to monetary policy. So until that monetary policy uncertainty subsides, that there is that kind of risk potentially to the downside for risk assets. But in saying that, at the moment, this still looks like a garden variety pullback for NVIDIA, for the NASDAQ, and as we'll see in a moment too, the S&P 500. Obviously, slowing momentum where we've come to expect that over the last couple of weeks, but still a trend that is moving higher, characterized by higher highs and lower lows. You could see that we saw a respective support just below 24,600 there for the NASDAQ last week. A bit of a downward sloping trend-lined resistance, which may prove to be perhaps a fairly important level actually, because we can see that kind of confluence of support around the 20-day moving average here, at least on our charts, as well as where it intersects. Well, it intersects with that kind of downward sloping trend line with that sort of 20-day moving average. But again, a market that is still characterized, you could still characterize as being in an uptrend, but one that might be, still the jury's out as to whether it might be threatened or not. I think the really key level to watch to sort of determine whether this is an uptrend that is breaking down or perhaps is still intact and is just consolidating is this kind of 23,950 level, maybe a little bit higher, just below 23,000, just below 24,000 realistically. You can see there, double bottom. If that broke below that level, it would sort of characterize a lower low for the price action, and that would start to justify from a technical perspective some caution about the long argument for certainly the NASDAQ, but also the S&P 500 as well, which we can also see here is remaining in a fairly clear structural uptrend, higher highs and lower lows. But once again, a pretty key level, what is around 6,500 or thereabouts, what appears to be some significant downside momentum building as we either consolidate or perhaps even test new lows. It has to be said, that is looking quite constructive here when it comes to the S&P 500. Now that I kind of look at it, because you can see here that we managed to not make a new low when we fell on Friday to the lows of the week. There was a bounce off the high. Let's start again. The low that was recorded there was higher than the low that was recorded than the week before. So we've got this wedge, symmetrical triangle pattern kind of setting up. That actually looks quite constructive as a continuation pattern. And again, just in the abstract, this is how these patterns generally work according to the textbooks. That's not to say that it will work this time, because it's technical analysis, it's more art than science. But one might suggest that there is that kind of a movement in such a setup. Again, that is not to say that will play out. That is not a recommendation to do anything in particular, but it's just to say that the price action is still lending itself to a market that is consolidating rather than reversing, and you would be continuing to look at whether there's a lower low made on the S&P 500 before starting to become sort of structurally bearish, at least from a technical point of view. Again, that's the textbook definition of things here. One other market that I wanted to show, again, because it's obviously very US centric, but everything starts from the US, in general. But especially now, given the preoccupation with monetary policy, is the US monetary policy, is just how we're setting up on the NASDAQ right now. And excuse me, I'm getting lots of messages on my phone, so I just make sure there isn't something catastrophic happening that I should be aware of. And there is not, which is good. Just to look at the dollar at the moment, I'm actually feeling quite bullish on the dollar. And there's one thing that I didn't mention before when it comes to this monetary policy story, and I think it's one of the reasons why we saw gold rip to record highs, precious metals rip to record highs, but also that happening alongside stocks and some other risk assets too, is that there's this whole notion of the run at hot trade at the moment. As you can tell, I like little rhetorical flourishes that throw trade at the end as a bit of a suffix. But what we did see, and this is what I think the Fed's responding to, is the market's pricing in very deep interest rate cuts for a little while there. One of the reasons why the US dollar was coming under pressure. But this is at the same time that the US government was planning fairly expansionary fiscal policy into next year. And not only that, other governments around the world were doing something very similar. Japan, for example, after the election of Takaichi, planning very significant fiscal spending, mostly on strategically important industries, as well as industries that are significant for the country's growth outlook going forward, and reshoring manufacturing and being exposed to semiconductors and all these sorts of things. Also, the Bank of Japan leaving monetary policy relatively loose by its own definition, all leading to this expectation that things are going to get pretty hot next year in the economy, and that could manifest in inflationary pressures. The Fed's basically responding to that now by saying, don't bet on rate cuts because things are looking like they could manifest in inflationary pressures. So that's kind of like that second order thing that happens in the markets. But we had that dynamic playing out for a little while. That was leading to, at least in the US situation, a weaker US dollar. But now that the Fed's changing course on this, we're sort of seeing the signs that maybe the dollar is bottoming out just a little bit, or has been over the course of the last few months, and could be preparing for a little bit of a break higher and maybe a renewed uptrend after this kind of 10% drawdown that we saw throughout the year, largely due to the end of US exceptionalism when it comes to US growth, or at least a kind of convergence with the US economy and the rest of the world, as well as all these other sort of themes that have played out throughout the year, like de-dollarization because of US trade policy and geopolitical risk, that being accelerated and what have you. But now the dollar's looking like it could be poised to try and break higher. And the critical level there to watch is if we do get a break through that kind of 100 level on the dollar index, all the rest of the world in terms of the currency landscape will fall around what happens with the US dollar. So before you make a real assessment on what a currency pair might do, you really have to ask first, well, what's the US dollar doing? Because that's going to drive things. You could say for Australia, there's a high prospect of now that the RBA won't cut interest rates anymore because of hot inflation data that we got recently. That has manifested in a higher Aussie dollar. But in saying that, if there are reasons for the US dollar to move higher, that's going to wash out that trade. The Aussie dollar will almost certainly still depreciate because the US dollar is the more powerful part of the pair there. Okay, so that's a bit of a wrap on things. We'll open up to some brief questions. Yeah, please throw some questions our way if you've got any. I'll do a little bit more on Forex. There's a good question, actually. There's two questions that popped up. First one about yields. This is something that frustrated me last week a little bit, actually, was that there was discussion about, the risk off that we saw in the markets, but the fact that we didn't see a bid in bonds. And there was a commentator on Bloomberg saying that, clearly this means this isn't a risk off moment in markets, because if it was a risk off moment in markets, then you would see yields drop as investors search for safety. But that's too crude an assessment of the situation and how markets work. just because there's risk off in the market, it doesn't mean that there will be a flow into things like US government bonds, because it depends on what the catalyst is for that risk off move. And the catalyst in this situation was fear that the Fed wouldn't be cutting interest rates quite as much, that potentially we could see a whole decision in December. And that inherently is going to lead, at least at the front end of the curve, a lift in yields. So things start in these situations with a increase in yields and then bleed through into other areas of the market, subsequently weighing them down. So that's a causality there. So if we continue to see, again, these fears that inflation is a bit more persistent and that the Fed won't be able to cut rates quite as much as previously thought, that'll certainly put upward pressure on the front end of the curve, maybe manifest in a little bit of upward pressure on the long end. But there's also the debate there that if you do see some of that relatively speaking, tighter monetary policy being discounted into the markets, that the 10-year should certainly not move up quite as much, so the curve would flatten a little bit. If not, you could even argue that it could drop, just that yields could drop at the long end just a little bit because long-term inflation expectations might be moderated. But nevertheless, when we're talking about the relationship between bonds and stocks at the moment, this isn't this kind of risk off play. This is about monetary policy. And if the bond market starts to reflect more hawkish monetary policy, stocks will still drop and yields will still be higher. There won't be that safe haven bid. So just something to highlight there, because at least someone who should know better at Bloomberg did not manage to understand that question particularly well. Just a little bit more on Forex. I've been asked, and perhaps we'll wrap it up after this because I'm pushing on through the, we're out of time basically. Like I said before, the US dollar is really what you have to focus on predominantly to start with if you want to get a sense of the directional bias in the markets when it comes to currency. But we do have some other things going on here at the moment which are worth noting. Some weakness coming through the Japanese yen, a really significant, I'm glad that we had the weekly charts up straight away, but a really significant break of downward sloping trendline support for the USD Japanese yen. And the reason for this is effectively that, the Bank of Japan seemed to be a little bit cowardly, even more cowardly than, perhaps you could argue the Fed has been in trying to get inflation back under control. And that this deluge, again, I've used that word once again, of fiscal support that has been earmarked by Prime Minister Takaishi is going to have the effect of pushing up inflation. The Bank of Japan isn't going to respond quick enough, and ergo the yen has to depreciate because real yields are still likely to remain fairly negative. Monetary policy in real terms is going to remain expansionary, and you combine that with the fact that the Fed seems to be talking a little bit tougher about the outlook for US interest rates. That's putting that upward pressure on the USD JPY. Effectively, I think this is one of those pairs. The pair is at a huge risk of the BOJ pretty much just developing a little bit of chutzpah and pretty much shifting its stance on monetary policy to reflect more hawkishness. But for now, you can see a fairly key technical break of a pretty key technical level, and the fundamentals seemingly pushing in the direction of a stronger USD JPY. Don't want that. I want the Euro USD. Actually, I'll talk very quickly just about the pound and dovetail that into the FTSE, and then we'll call it a day. But just one to watch here as we come up to this sort of autumn budget update, starting to look relatively weak for a couple of reasons. The pound, one, we had some weak data last week, both in terms of GDP and labour market figures, which after the last Bank of England meeting, which showed a much more dovish vote split, that is, more people voting for a cut than was expected, it's starting to position the markets for a rate cut in December and maybe further to come next year, despite inflation risks persisting. That, combined with what is looking like a fairly politically expedient and short-termist budget that ignores some of the structural long-term economic problems the UK faces from a fiscal settings point of view, that could be rolled out in the coming weeks, and that could compound the dire fiscal situation that the UK is in and put further downward pressure on the pound. And you could see that on Friday when there was that rumour the Chancellor would be walking back income taxes to improve the fiscal position, that we saw the pound drop, as well as gilts, as well as the FTSE as well. And I'll just give you a bit of a look at the FTSE and some of the key levels there. That's that kind of, pretty much ominous, deadly mix of stocks bonds and the currency falling at the same time. And that normally happens when people are worried about the sustainability of a country's fiscal settings. It's almost a little bit of an emerging market dynamic where there's a sort of a crisis of faith in the country and the government at the time. But here's the FTSE. Just a few key levels to watch here that are actually quite noteworthy. We have seen a pullback from record highs. A lot of that was due to the expectations of rate cuts. Still actually looks quite bullish from a structural point of view, like we saw with other indices, a pattern of higher highs and lower lows characterizing a clear uptrend. But we are seeing this pullback, a very big drop on the daily RSI back to fairly neutral levels. Key level to watch for me here is, around 95.50 or 95.60, depending on where you want to draw your line. Clearly a level of previous resistance that turned into support and was respected. A textbook consolidation could be happening here, where if we do see prices stabilize here around these levels for a little while, that would be, signs of a pretty healthy uptrend. If that breaks, you would suggest that, a little bit like we said before with US indices, we're seeing a sign of a lower low, maybe the uptrend's breaking down. But if we can see a continued push higher, which a lot of it would depend on basically politics and a budget that is palatable enough for the markets, as well as continued rate cut expectations in the UK, and then also broader market sentiment holding up reasonably well. A breakthrough that kind of 97.80 is a pretty key level of resistance in the short term, and a confirmation of the ongoing bull market would happen if we do break to, of course, a fresh all-time high with resistance currently around 99.30. That could put basically the market on track for 10,000 if that break were to occur. Okay, so that's a lot of my voice for the one day. So we'll wrap it up there for another session. But thank you so much for your company today. Apologies for Danny's absence, of course. Feeling a little bit unwell, a seasonal kind of flu, perhaps. Sorry, I'm just trying to open my screen here. But please continue to join us each week and tell your friends about the webinar. We do record this webinar as well, so that if you do want to see that again and watch back anything that you've seen here today, you can do so on YouTube. It's the Market Mondays webinar. Otherwise, I do hope you have a very wonderful week, a successful trading week, and as I try to work out how to flick this off, I do hope to see you again in the not too distant future. Cheers.